Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to do a quick review of velocity banking credit cards. But before we actually go into the topic, I just want to do a quick reminder that tomorrow we're going to have a live stream uh, at 6 p.m. Eastern. And it's exclusive access for those who are channel members. So if you're not a channel member, you won't be able to see the live stream or the recording after. But if you do become a member, you get access to these exclusive emojis, you get access to the live stream, and it's really easy to join. You just click this link right here, right? It'll ask you to join, or you can click the join button above, right? So if you want to be part of a member of the channel, it's only 99 cents. Go ahead and click it, and then you have exclusive access to this live stream. Now, for today's topic, we're going to do velocity banking with credit cards, right? And so here we have this website, Bankrate. They have this minimum payment calculator. So if you have trying to run through a hypothetical scenario, sometimes I go through ChatGPT. ChatGPT gives me nonsense. So if you want something that's always going to give you a consistent output of information, go ahead and use Bankrate, even though this website seems to be a little bit broken because it says it's going to take me infinity time to pay interest. I don't know how that works, but or maybe it's actually correct. I don't know. If it's 2.8% of the balance, maybe it's not even covering the interest. Kind of like now that I think about it. Okay, but whatever. So uh you just put some numbers in the minimum payment calculator, and then you could kind of give yourself scenarios to practice with. And here's the other thing too. This is an estimate, right? So this isn't going to give you able to predict your situation because every single bank is different. And if you call up like 5 banks, they'll tell you, oh, how do you calculate? You ask them, how do you calculate the minimum payment? And they'll say, oh, it's either $25 or 2%, whatever's lower or whatever's higher, and they'll say things like that. And so it's your job to be proactive about your finances and figure out what the lending institutions how they operate, because usually if you just call and ask, they'll tell you, right? And most people are afraid to do that. Now, let's do a situation with velocity banking where we have 2 credit cards, and I actually kind of pre-wrote this scenario, right? So actually, let me just start from the beginning right here, and let me erase this, and let me actually erase all of this too. Okay, so what are the first 2 things that we need when doing velocity banking? The first thing that we need is a budget, right? Because what we're going to do is when we're at our budget is we're going to figure out what our cash flow is and what debts we're going to pay off. And every debt that we pay off is cash flow that we recovered. Now, in this example, it's just going to be really simple. We're going to have 2 credit cards, and I used Bankrate just to kind of give me some numbers of what the minimum payments would be. I think 28% interest is reasonable on a credit card. It's just 27, and especially if you carry balances, then you're just paying a couple $100s of interest every single month, and your goal is just to kind of pay that off as quickly or as soon as possible, right? And we're gonna make this really simple. So for this person, we're gonna assume that this person actually has a home, but it's paid off, right? So maybe they live in a cheap area, so there's no mortgage, but we need a home because we're going to use something called home equity line of credit. So as you can see here, I've created a budget, really simple, 2 credit cards, got their payments from bankrate.com. And now what we're going to do is we're going to figure out how to make it easier to pay off these debts and just employ a strategy where we just set it and forget it. Like, I don't know if you've ever seen those old 90s infomercials about like those chicken roasts, and there's a guy, I forget what his name was, but his whole shtick was that all you had to do is put the chicken in the oven, you just set it, and then you forget it. And that's what I think about velocity banking, because what we're going to do, instead of your average American who uses their checking account to pay the bills, what we're going to do is we're going to use our line of credit as our operating account to pay the bills, right? So what we're going to do is just kind of write this down. So $5,000, zero in our checking savings, and then we're going to kind of redo our expenses, and you'll see how that works. So the basic strategy is that we're going to put our entire paycheck into the line of credit. Now, here's the thing. I didn't talk about what line of credit we're going to use, and if you don't know what a line of credit is, all it is an a financial tool where you borrow money, pay back, and use it over and over again, right? And there are different types. So if you have a credit card, that's actually a line of credit. But for this example, we're going to use something called a home equity line of credit. So home equity line of credit, right? So let's say I have a home, like it's worth $100,000 and it's actually paid off. You know, in some parts like California, that doesn't exist, but in some parts of the country, they do exist. So I'll just say we have a $80,000 home equity line of credit, and think of it as like a credit card based on the value of your house, right? So they might, if you have a paid off home for that's worth $100,000, they might just lend you money, kind of give you like a credit card for about $80,000, and they'll give you kind of cheaper interest rates too. So let's say it's 10%, right? Now, what can we do to easily pay off these credit cards? So one thing that we can do is to look at this. The interest rate is 28%, 27%. If we move all of this to a 10% interest rate, a line of credit, and we don't even do velocity banking, we're still going to win, right? But I see this as a double win. And in most of the videos that we have here, we actually don't talk about the interest rate that much because we're more interested about the cash flow. But if you're in a situation where you're moving high interest rate credit card debt to a lower interest rate line of credit, that's always a total win, right? But there are certain situations where you want to use the line of credit to kind of pay off a low interest rate loan, right? Because loans pretty much always have a lower interest rate than lines of credit. It's just the nature of the product. All right. So again, we put our entire paycheck in here. We take out our expenses, and our checking and savings should pretty much go to zero at the end of every single month because we're going to use our cash flow to bring down the balance of the credit limit. Okay. So now let's go ahead and do this. This is going to be zero. This is going to be zero. This is going to be the same. $3,000 expense is kind of a lot, but you know, inflation nowadays, who knows? So we're going to pay this off. What we're going to do is going to say, okay, let's transfer some of this debt, $38,000 into this line of credit, 38,000. Okay. Now let's figure out what our new expenses are, right? So it's actually this minus all of our general expenses, which is just 3,000. So it should just only be 2,000, right? And so now, I'm sorry, 3,000. What am I doing? I was thinking about cash flow. I was like, okay, our cash flow is this minus 3,000, which is our expenses. So now what's going to happen is that we're going to put this $5,000 check to here. This is going to satisfy the minimum monthly payment. And then we're going to go, the balance is going to go down 2,000 every single month, right? Because we take out our 5,000, we put our 5,000 here, it goes down by 5,000, but eventually go up by 3,000, right? And it's going to keep doing that every single month. Okay. So now let's just do this. Let's just estimate what the balance is and how long it's going to take to pay it off. So what we do is just get the previous balance and then subtract it by 2,000, right? And then we just copy and paste the formula. Okay. All right. So if we're not taking into account the interest, which we should, let's just go ahead and do this. +1 and copy and paste it. So about 19 months it's going to take us to pay off this line of credit. Now it's actually going to take us a little bit more, but we're just going to estimate the interest afterwards and then just kind of add it at the end, I guess. I don't know. I probably need to do it more accurately, but I'm a little bit lazy, but good enough is good enough. All right. So the way that we estimate the interest is we take the previous month's balance, multiply it by the interest rate, this is 0.1, and then you divide it by 12, right? So the interest rate is quoted annually, but they always calculate monthly, and then when you do it, they calculate monthly. They actually use the average daily balance, so it's not the previous month's balance. So we're overestimating it. So it's kind of going to be between probably 38 and 36. I don't know. So, but let's just use a previous month's balance. Go ahead and sum it up. All right, and so now we're going to have to pay $3,166 approximately in interest, right? So how many months of our cash flow is that? That's actually 2 months, about 2 months of our cash flow. So we could say, oh, it's going to take 20 to 21, about 21 months to pay this off, right? So that's less than 2 years. Think about that. So a lot of people, they're gonna freak out about, oh my goodness, I got $38,000 of credit card debt, and at these high interest rates, and I'm gonna take a look at it. It's like, all right, what's the big deal? I mean, make more money, obviously, but that's not always a solution. But you also have to know how to manage your cash, and this is why I would call it a set and forget system, because all I have to do is just make sure I dump this paycheck into this line of credit. I just dump it and then take my expenses out. Now, if you want to go a little bit further, do this, right? You still use one of the credit cards for your expenses, but always pay it in full from the line of credit. And what you do is that, because the credit cards don't charge interest, the moment that you use the money, what you do is that you pay off the balance statement every single month at the last possible moment from your line of credit, so that you delay the interest. Because if we're actually directly paying our expenses from the line of credit, well, guess what? The moment we pull the money is the moment that interest is accruing. And so we might want to kind of use a credit card, use the good sides of a credit card. It's not all bad. Use the positives of a credit card, so that maybe we can rack up some rewards points, stuff like that, and delay the interest and the line of credit, right? But let's go ahead and let's see. So let's write down what we have. So about 21 months, okay? So 21 months. Actually, let me write down here. So result, 21 months to pay off 38K credit cards and 3K of interest, right? So 3,000 of interest. Spelled it wrong. Okay. So let's go down here, and $3,100. Yeah, 3K. So 21 months, that's not even 2 years, right? Actually, let me do this. Equals 21 divided by 12. So it's about 1.75 years. And that's it, right? So 1.75 years. How easy was that? Most people would freak out about this. In fact, I'm going to tell you a little bit about myself. Beginning of this year, I had $115,000 in credit card debt, and now I'm around, like, I don't know, 45, or line of credit debt. Now I'm like 45. So no need to fear this. If you know how to manage your cash flow correctly and not spend up the wazoo, you can get this too. But I don't guarantee any results. All right, so hope we had some fun learning about and reviewing velocity banking. If you're interested in joining our group, go ahead and click the Google link form below. And again, if you're interested in joining our live stream, make sure you click that join button in the YouTube channel somewhere. All right, have a great day. Happy Friday, and we will see each other tomorrow.